Hello and welcome to China Biz. Now, the election of Francois Hollande as the new French president on Sunday has sparked concern over Europe's fiscal future, with voters in Italy and Greece also throwing their support behind anti-austerity candidates in recent days. Earlier today, representatives from the IMF gathered in Beijing to discuss the world body's current thinking on the global economy. Andre Meyer, the IMF's representative in Hong Kong and an expert on financial stability, stressed that despite the apparent winds of change, there is no one-size-fits-all solution for all of the Eurozone's member states.
We've endorsed the fiscal compact because it creates an anchor for longer-term fiscal sustainability in the euro area, but we've also emphasized that you need tailored strategies. Not everyone should step on the brakes immediately. A country like Germany, which is not facing market pressures and which has relatively strong public sector balance sheet still, has the space to reduce its fiscal deficit more slowly. And that should be done because you need some overall support to the euro area. If some are cutting back particularly hard because they have to, others should be doing a bit less.
After the meeting, I spoke to Murtaza Syed, one of the IMF's representatives in China, to get his thoughts on how developments overseas are affecting the Chinese economy. Now, Murtaza, first of all, given the slowing growth rates over in the US and the political chaos in Europe, what are the risks that you see to China and how severe are those risks?
I think we feel that external risks have receded somewhat since the last time we put out our World Economic Outlook forecast in January. The crisis in Europe seems to have abated. The US numbers seem to us to be a bit better than we had expected. So in that sense, actually, external risks have come down. But the good news for China is that it's built up quite a lot of fiscal space. It's run a very prudent fiscal policy for many years. And so even if there is to be an unforeseen external shock, China has quite a lot of fiscal space. It could have a big fiscal stimulus if needed to try and counter the effects of any external shock. And that would help keep growth quite high in China.
Now, we've also seen some pretty concerning numbers coming out of the Canton Fair in recent days, with demand much weaker than expected, in particular from Europe, for China's exports. How concerning is that? You know,
our central forecast is that net exports will detract about 1 percentage point from growth this year. That's already quite significant. But the good news is that China's domestic demand has been doing very well through this crisis. Both consumption and investment have been very strong. Consumption, because the labor market has been very strong, income growth has been strong. Investment, partly because of the infrastructure stimulus that the government put in place, but now also private investment has really been quite strong, even outside of real estate. So the domestic engines to us seem to be quite strong, and therefore even if exports look weak, which we think they will this year, there's enough momentum there to keep the economy afloat.
Now, earlier this year, the IMF lowered its forecast of China's current account surplus as a share of its GDP. Do you think that change is more driven by cyclical factors or because of government efforts?
Yeah, I mean, I think part of it was cyclical, but there are more lasting effects at play. We think there are 4 main reasons why the current account has shrunk as a percent of GDP. The most important one is terms of trade. So basically, prices for China's imports relative to China's exports have been rising because China has been importing more oil, more minerals, more metals, and its exports tend to be in sectors where prices have not been growing that high because competition is very strong, machinery, electronics. So terms of trade have worked against China. That's been the most important factor, but there have been others as well. The exchange rate has appreciated by almost 15% of GDP between the middle of 2008 and 2011. We've also seen global demand being much lower than before the crisis. And investment levels in China have been very high, and that's sucked in a lot of imports. So those are the 4 main factors behind the decline in China's current account. The government has played a role. I think the building out of the social safety net is going quite well. That's helped reduce savings, boost consumption. But more needs to be done, really. I think to have a successful rebalancing, both externally as well as internally, you really need to get household incomes to rise. And there's a big agenda there. You need to reform the financial sector. You need to increase the cost of capital, other inputs of production. You need to increase labor income. You need to appreciate the exchange rate. So there's still an unfinished agenda.
That's all for today's China Biz. I'm Mark Dreyer. Thanks for watching and goodbye.